So let's start with financial year, assessment year and previous year. What is financial year? Well, it's defined in the General Clauses Act. Financial year means the year commencing on the first day of April. Okay, so that's the financial year. Always first day of April to March 31st of the next year is the financial, next calendar year is the financial year. So what is the financial year 2015-2016? Well, 1st April 2015 to 31st March 2016. So we're currently in the financial year 2015-2016. Okay. Now, what does assessment year mean? Assessment year means the period of 12 months commencing on the first day of April every year, essentially. So the assessment year, right, for 2015-2016 is 1st of April 2015 to 31st March 2016. Now, for the purposes of the Income Tax Act, previous year means the financial year immediately preceding the assessment year. Okay, I beg your pardon. Now, what I'm about to tell you is so important. Okay, so pay attention. When you earn income from, let us say, April 1st, 2014, okay, to March 31st, 2015, you have earned the income in the financial year 2014-2015. Okay, but the tax will be assessed in the year commencing April 1st, 2015 and ending 31st March 2016. So for the purposes of the Income Tax Act, right, when you earn income in the financial year 2014-15, the financial year 2014-15 is the previous year, and the tax is assessed from 1st April 2015 to March 31st, 2016, which becomes the assessment year. Income earned in FY, right, income earned in FY 2014-15, right, that income, right, is assessed in the financial year 2015-2016. So, right, if I earn 10 lakh rupees between 1st April 2014 and March 31st, 2015, that 10 lakh rupees will be assessed for income tax, right, in the year commencing 1st April 2015 and ending March 31st, 2016. That is the assessment year. Tax is always assessed for the previous year. Okay. So, income tax is charged in respect of the total income of the previous year and not the assessment year. Okay, I'm going to repeat that. Income tax is charged in respect of the total income of the previous year and not the assessment year. So, I'm going to give you an illustration. Sajal earns rupees 3 lakh in the financial year 2014-2015. His income, Sajal's income, is assessed and charged in the financial year 2015-2016. 2014-2015 is the previous year. 2015-2016 is the assessment year. And the important dates, first day of April, right, to the last day of March. 1st April to 31st March. Okay, very, very simple. Now, we come to Section 2 of the Income Tax Act. Section 2 is a very, very important section, probably the most important section because it's the definition section. Section 2, subsection 7 defines who or what is an assessee under the Income Tax Act. What is an assessee? Who is an assessee? Now note my use of the terms what and who. Assessee means a person by whom any tax or any other sum of money is payable under this act. Right? So you're an assessee. When are you an assessee? When any tax or any other sum of money, not necessarily just tax alone, any tax or any other sum of money is payable under this act, the Income Tax Act. And an assessee includes every person in respect of whom any proceeding under this act has been taken for the assessment of his income or assessment of fringe benefits or of the income of any other person in respect of which he is assessable, or of the loss sustained by him or by such other person, or of the amount of refund due to him or to such other person. What does that mean? Right? Essentially, a proceeding may be taken out against you by the income tax authorities, even though your declared income is only 2,40,000, because they believe, no, your income is actually 5,40,000. Under 2,40,000, you are not, right? You are not required to pay any tax under the IT Act, but a proceeding has been taken out against you, and the income tax authorities have decided to assess you because they believe that you have hid, right, additional income of rupees 3 lakh from them. And therefore you become an assessee. Okay? Who else is an assessee? Every person who is deemed to be an assessee under any provision of this act, right? The word deemed, what does that mean? Even if a person does not meet the requirements of section 2 subsection 7, right, a law, another provision of this act itself or the Finance Act even might deem certain categories of persons as assessees. You're a deemed assessee. Okay, like in CPC, you have a deemed suit, right? We did that in our CPC course back, right? Essentially, certain actions are deemed to be suits, basically. Okay, now, every person, right, who is deemed to be an assessee in default under any provision of this act, right? So if you are in default under any provision of this act, you're also deemed to be an assessee. I'm going to give you 2 illustrations that will make the concept of an assessee clear to you. Harsh earns an income of rupees 2 lakh in the previous year. He is a person, but not an assessee under the Income Tax Act, as his income is below the maximum exemption limit of rupees 2,50,000 and no tax is due from him. Simple example, right? Now, slightly more complicated example. Supratik, who earns an income of rupees 1,75,000 in the previous year, fails to deduct the tax at source, TDS, on salary paid by him. So let us say Supratik, right, owns a company. Supratik owns a law firm. He employs people. Okay? He employs people, right? And Supratik essentially earns an income of just 1,75,000, so he is not liable to pay tax. However, Supratik fails to deduct tax at source on the salary that he pays. You must deduct tax at source on the salary that you pay, as we will see in Unit 3. Failure to do so would make Supratik an assessee in default. It would make Supratik an assessee in default even though the income he earns is below the maximum exemption limit because he has failed to deduct tax at source, right? He has willfully contravened a provision of the Income Tax Act, making him an assessee in default. Okay, so important that you understand the concept of an assessee. Now, going back to the example involving Harsh, we said Harsh is a person but not an assessee. He is not an assessee because he earns 1,75,000. I'm sorry, Harsh is not an assessee because he earns rupees 2 lakh, which is 50,000 rupees below the maximum exemption limit of rupees 2,50,000. But even though Harsh is not an assessee, he is a person under the Income Tax Act. So what is the meaning of person under the Income Tax Act? Again, we go back to the all-important section 2, subsection 31 of the IT Act, which defines what a person is and whom or what a person includes. And this is so important. A person includes an individual, a Hindu undivided family, a company, a firm, an association of persons or a body of individuals, whether incorporated or not, a local authority, every artificial juridical person not falling within any of the preceding subclauses. Okay, so now I'm going to break down, right, each of these subcategories for you. A person includes an individual, right? Obviously, we know that. That doesn't really require any further, right, explanation. Okay, it includes a Hindu undivided family. Again, if you've done property law, you know what a Hindu undivided family is. Okay, very straightforward. It includes a company. Okay, so we're going to go into this in a bit more detail when we do assessment of companies, okay, in later units. A firm, a partnership firm, and an association of persons or a body of individuals, whether incorporated or not. Now, this concept requires a little bit of explanation. An association of persons or a body of individuals or a local authority or an artificial juridical person shall be deemed to be a person, right, whether or not such an association or body or authority was formed, established or incorporated with the object of deriving income, profits or gains, right? This was what the Andhra High Court had to say in Deccan Wine and General Stores versus the Commission of Income Tax. Okay, what did they say? They said an association of persons does not mean any and every combination of persons. It is only when they associate themselves in an income-producing activity that they become an association of persons. I want to give you an example from England, actually. When I was training as a barrister, they have this concept of sitting in chambers in the United Kingdom. Barristers in England are actually self-employed. They are self-employed. They cannot be employed by anyone. Barristers cannot be employed. There are a few rule changes in this respect, but we're not really going to go into that really. It's not relevant for our purposes, okay? So barristers, essentially, are self-employed and they sit in chambers. But what do? one barrister will sit with another 10 or 12 barristers, maybe even 30, 40 barristers, depending on the size of chambers. They essentially come together in an income producing activity because they say, okay, we will sit in these chambers, whatever little cut, whatever we earn, we give a little cut to the chambers and to our colleagues. Why? Because we are a force to be reckoned with when we associate together, right? So most often you have a head of chambers who is a very prominent barrister, who is a senior counsel or silk, as they say in the United Kingdom, right? And under him, he will have several barristers who say, okay, his name will attract clients to these chambers, right? Although we are self-employed, we give everybody, all the other chambers, the tenants as they're known as, we give them a small piece of the pie, basically. So that's what an association of persons is. Yeah, it's not any and every combination of persons. It's not a random combination of persons. It's only when these persons associate themselves in an income producing activity that they become an association of persons, and these association of persons constitute person under the Income Tax Act, thereby bringing this income producing activity of the association of persons within the ambit of the Income Tax Act. Okay, these association of persons must combine to engage in such an activity. The engagement must be pursuant to the combined will of the persons constituting the association. There must be a meeting of the mind, so to speak. In a nutshell, there must be a common design to produce income. If there is no common design, there is no association. Common interest is not enough. Production of income is not enough. There must be a common design to produce income. The absence of a common design is what principally distinguishes a body of individuals, right? The absence of a common design is what principally distinguishes a body of individuals from an association of persons. That was the Andhra High Court, basically. So I'm going to give you a couple of illustrations to highlight the difference between an association of persons and a body of individuals. So, where Nishant, Anusuya, Sudhir Law Review Limited and HR Guru, a partnership firm, joined together to host conferences that are designed to benefit practitioners and law students, they may be referred to as an association of persons. Where Nishant, Anusuya and Abhishek joined together to host conferences that are designed to benefit law students, they may be referred to as a body of individuals. Okay? Right? When it's an association of persons, there always has to be, right? It always has to be an association of persons when there's a private limited company or a partnership firm involved, as is the case in the first illustration. So Nishant, Anusuya and Sudhir Law Review Limited, right, join hands with HR Guru, a partnership firm, to host conferences that are designed to benefit practitioners and law students, right? They're an association of persons because that's an income producing activity. They charge a fee for people to attend the conferences, basically. Okay? But where Nishant, Anusuya and Abhishek, three individuals, no affiliation to any private company whatsoever, joined together to host conferences that are designed to benefit law students, they may be referred to as a body of individuals, basically. Okay, so they say the absence of a common design is what principally distinguishes a body of individuals from an association of persons. Okay, so you might make the case that, okay, maybe Nishant, Anusuya and Abhishek, hey, isn't there a common design? Isn't there an association of persons per se? You could argue it, right? So it's very difficult for me to pinpoint an illustration and say this is a body of individuals. It's very fact intensive. But just note that where you have a company or a partnership firm joining hands with other individuals, it will always be an association of persons, right? The key is they must associate, right, with the object of carrying out an income producing activity, with the object essentially of generating income. They don't actually have to generate income to be an association of persons, but the purpose essentially must be to generate income. Now, right, we come to artificial juridical persons, right? What is an artificial, who or what is an artificial juridical person, right? The courts have held the very words juristic person connote recognition of an entity to be in law a person which otherwise it is not. In other words, it is not an individual natural person, but an artificially created person which is to be recognized to be in law as such. Examples: the Bar Council of India are my parent body, I am an advocate. idols, deities in temples, God, University of Delhi, for example. These are all artificial juridical persons, essentially, right? Now, by virtue of, I'll give you an example, okay? And we'll take the case of Bar Council of Uttar Pradesh versus CIT, that's Commission of Income Tax, decided by the Allahabad High Court. And I quote, by virtue of Section 5 of the Advocates Act 1961, the Bar Council of a state is a body corporate having perpetual succession and a common seal. With power to acquire and hold property, both movable and immovable, a Bar Council may sue or be sued by the name by which it is known. Thus, it is clearly a juristic person and would be covered by the expression artificial juridical person. So yes, the Bar Council of India can be taxed, but in most cases, artificial juridical persons like the University of Delhi, Bar Council of India are exempt from taxation, basically, right? In most cases in India, artificial juridical persons are exempt from taxation, okay? So, I've essentially now so far explained what? Financial year, assessment year, previous year, association of persons, body of individuals, artificial juridical persons. We've looked at how Hindu undivided family, a company and an individual all constitute a person under the Income Tax Act. Okay, so that's person alone. Okay, so now let's come to the all important definition of income, right?